We take you to Tom Keene and Michael McKee of Bloomberg Surveillance. They're talking to Bill Gross of Janus Capital about this very same question. What do these numbers mean to Janet Yellen and the Fed?
So what she's concerned about are imbalances in financial conditions. That means stock prices. That means yield spreads. That means money moving into various asset classes that suggest some type of potential bubble. And so financial conditions are the key for her Fed and perhaps the Fed of the DOE.
Well, what do you think at this moment from Bill Gross's perspective about financial conditions?
Well, I have the same sense. It's hard to call the end of a bull market or to speak to bubbles such as the dot-com bubble or any other period of time, but there certainly is a speculative fervor in markets and a lack of liquidity. I mean, you can't leave for the bathroom and come back without the market having moved by 1% up or down, and that to me indicates that markets are certainly not stable or steady. They may not be overpriced necessarily, but they're volatile, and the volatility itself is something that they want to zero in on.
If we assume, Bill Gross, that everyone, including you, has Fed exhaustion over the linkage of our economic policy to microanalysis of a jobs report, let's pass out the blame right now. It's Friday. It's Blame Friday. Who do you blame for the silliness that we've boxed ourselves into?
Well, I blame some fundamental forces and factors and analysis. Slowdown in China. I blame the uncertainty in terms of what the Fed is going to do and when they're going to go and by how much. Ultimately, I guess I blame leverage and debt and these models. Some of which are levered and dependent upon what they call VAR, value at risk, that actually, Tom, have been around for a long time. It's not a new deal. But the thing is that when a market moves significantly in one direction or another, the value at risk changes because of the volatility, and it induces more selling or more buying, and it sort of feeds on itself.
That's a nice summary from Bill Gross of Janus Capital. But, Bill, I look at what you mentioned about China and just the VAR we saw overnight from Brazil, China, the Hong Kong PMI. We know those are things Stanley Fischer pays attention to. Will that matter September 17th?
No, I think it should. I think any central banker, and certainly those at the IMF and other global agencies, are well aware that there are significant imbalances in the global economy, and that speaks to not only trade balances, but it speaks to financial markets. It speaks to currencies. I mean, the Brazilian real that you just mentioned is still, on a real basis, highly overvalued, and one would suggest has further to go. These conditions exist in Asia in terms of their currency levels. Investors are being concerned by the draining of reserves as these countries, China included, attempt to support their currencies and how long that can continue. And so, imbalances everywhere, and the imbalances are an afterthought or an aftermath of the Great Recession.
Well, Bill, you're unconstrained. Can I make some news this morning? What are you doing on Brazil? Are you out of Brazil? Do you short Brazil? Or is there an opportunity here?
Well, I'm not in Brazil, but yes, it's enticing. You can invest in the currency and earn, 14.5% overnight or over a week or over.
That's better than Mike McKee does.
It is. The question is, on an annualized basis, does the currency depreciate by 14.5%? So far, it's been doing that. So you pick your poison, but some of these countries, my favorite emerging market country, the strongest one in my opinion, and I don't even think it's an emerging market country anymore, is Mexico. It's got half the debt of the United States. It still has 2% growth. Inflation's under 3%. It's got the cast of emerging markets, and so when risk off appears on your screens, then Mexico won't do well. But I think there's some emerging market countries that can do well. And by the way, just to point out, Mexico's forward yield curve going forward is in the next 2 years is perhaps 300 basis points higher in terms of a future increase than in the United States. So I think it's really overextended and ultimately is of value.
All right. I've just got a minute left. We'll ask you the money question when we come back. But in the meantime, all the things you mentioned, if the Fed moves, if the Fed doesn't move, does it affect those things, or are we just going to be talking about this volatility ad infinitum until they do?
Yeah, well, it depends on how they move. How many times have I said that? Have you heard that? It depends on the press conference in September where the plan is supposedly laid out. They don't want to make it conditional, but yet they, in fact, know that they have to make it somewhat conditional in order to dampen volatility. And so we'll listen to Yellen and listen very closely. I think they're one and done for 6 months. I think that's all they can do. And if any other language pops out, then you're going to see more volatility.